Now we'll have a look at the use of Fibonacci in uptrending markets or up price swings as the market is making higher highs and higher lows. Once again, when we start at a low and price rallies to a high and makes a very distinctive high, the more distinct the better. So the more candlesticks there are to the left and to the right, the more profound and the more respect that the market has for that specific price. And as we watch price retrace, we would pull our Fibonacci tool from the low to the high, and our retracement levels will be pre-calculated into the chart. As we watch price retrace to the 38%, 50, 62%, 79, or 100, we watch price bounce, rally to 127% extension, and potentially as high as 162% extension as well. Let's look at it here on a chart, and this is a chart that I pulled up, and this is a trade that I participated in. And what I will do is quite often when I experience these types of nice learner-friendly scenarios, I call them, then what I'll do is I'll simply just freeze the chart and use it for educational purposes as well. This was an Australian dollar scenario, and I typically was trading it and more or less viewing it off of a 1-hour chart, but this is a 2-hour chart. I've just compressed it to make it a little bit more viewer friendly. And we see price has been in this downtrend, making lower highs and lower lows. Then we reached a low, and as price moved up to as high as this level of resistance, which we're going to cover in the reversal patterns section, when price reached that level of resistance, I had anticipated the possibility of the next price swing being up, and this being a potential key reversal day. The days are separated by these vertical lines, and watching on the CD you cannot see the dates, but if you look in your manuals you can see the dates on the lower part of the chart. Pulling my Fibonacci from this low to this high, the tool has the parameters set into the software, and it automatically calculates the 38% retracement, 50, 62%, 79, and 100. So price falls. As liquidity picks up during this section, price falls to 62% retracement, which is equal to the left shoulder of this Head and Shoulders. And we see it rally. It actually moves. You see how price, the reason why you have to take profit early is because you see how price moved through this high and then struggled to get above. Look, it moved through the high. The next candle opened, came all the way back down here to the lows of this consolidation before taking its next leg up. And its next leg was quite aggressive, moving all the way up to 162% extension of this price swing. Rally, retracement, extension to 162%. And we see now price is now consolidated in the 75.20 to 75.40 range of 20 pips. And here is the price swing distinguishing the lows and the highs that are connected and the constituents of the price swing. Again, we see an Australian dollar 2-hour chart. Australian dollar traded against the US dollar. We see here, once again, we see the lows here. Price came down, tested the lows, formed a hammer. A distinct rally, very decisive rally. And after a parabolic rally like this, we can anticipate a retracement. I would usually look for price to first settle here at the 7400 area and the 38% retracement, but in fact in this case there is considerable profit taking and squaring of positions. Price moves all the way down to rest at the 62% retracement, and combined with this level of resistance, it rests here and forms, it tests this level, makes 3 attempts at that level in its range of consolidation before taking its first leg up to 127% extension. It retraces to previous resistance, now support, takes its next leg up to 162%. Looking at a different scenario now, and of course they all will be different scenarios. We see a Euro US dollar 60-minute chart, and price is in this somewhat indecisive choppy range. You see how it ranges, then it moves out of the range, it ranges again, then it moves out another range, and then it moves out of its range. Somewhat of a choppy environment, but let's make sense of it all. Price moves out of its range here, starts to move above these highs, and we see a real nice, this is a downswing here. This downswing here, by the way, it is what's called a Gartley, and we'll cover that in a later section. So just hang on, folks. We're going to get there. We come all the way down here to the 62% retracement level of this low to this high, retraces 62%, which converges with this 10-day moving average before rallying. Now it forms a real nice doji here, dragonfly doji, a nice extended wick downwards, and followed by a nice up move. Now you make your trade, you can make your trade as close to this level as possible if you see a nice price action on a smaller time frame and you see that price is unwilling to go below this point, showing weakness. Then you can make the trade anywhere from down here to all the way to the top of this candlestick. The more you wait for it to go up, the bigger your stop is going to be. Your stop should be below the 62% retracement level. But the important thing is this, that you take profit before it starts to makes attempt to penetrate the above resistance. And the reason for that is it may not get through resistance and it may come all the way back, making you a wobbly need trader. And look, it makes another attempt at the highs, struggles, consolidates below the highs before the next section, trading session, as it starts to move above. Actually, this consolidation is an economic report. It was a UK fundy at this time, as I recall, and then we saw a generous move following. It was a UK fundy that affected the Eurozone as well. Here's our price swing, extending up to 162%. What I want to point out here is you see this 162% extension. This is typically it's an exhaustion level where we will see price begin to slow or become exhausted, where the retracement levels will most often be very, very accurate and very right on the retracement levels. And the extension levels are just, again, simply exhaustion points, and we don't look for them to bounce exactly at the level. We just look for price to fade or start to slow at these levels. Another point of note is from this low, 1 day passes, 2 days pass, then we go through a weekend, and on the 3rd day it reaches its extension price target. So this whole price swing occurs over a period of 3 days. Looking now at the British pound, we see price failing to hold below the previous day's low, a retest of price. In fact, we just saw this yesterday. I traded such a scenario just yesterday. And price rallies. This is when you see this kind of spike down as a confirmation that price is unwilling to hold below the previous day's low. This can effectively turn out to be a key reversal day, and we can often see price, of course, move up. But typically in this scenario, the second leg, it is the second leg up for you Elliott wave theorists, the second leg up is typically a very, very strong leg. We see price retrace from the key reversal day. Usually on the key reversals days, it will retrace to the 38% retracement. We have here a previous level of resistance, now support, and usually this on a key reversal day, this 38% retracement also represents a central pivot point. And as you see, the second leg up rallies above the highs, extends to 127% extension where price fades, and then to 162% where price fades again, becomes exhausted. And you see these candlesticks here. You notice how aggressive price action is right here. There's aggressive buying that happens here. And as price fades right here, we see that this is more of a decline in interest in buying rather than selling pressure. As we see it come down and rest at this level of resistance, becomes support to the market. And here are our price swings. Let's look at a combination of several consecutive swings on this Euro 60-minute chart. And this spike down below these lows, this is very distinctive of a key reversal day. When price makes an attempt to go lower, is quickly rejected, and we see aggressive buying as a result. Price, there's a big move between this low and this high here, and price is unwilling, or there's not enough flows or volume to push price above these highs for the day. But be careful and watch on the next day to see what happens. We see price retrace somewhat, and then during Asia, what's my rule during Asia? We made an attempt at the high, but it was unwilling to move above approximately 70% of the time. When Asia makes an attempt at the previous day's high, it is unlikely to go above. Often will offer a good trade in the opposite direction, in this case a short. Price retraces, you want to take your profit before the 38% retracement. We have the 38% retracement converging with this level of resistance. This 38% retracement, if I was to pull up my pivot points on here right now, in all likelihood it would be a central pivot point as well, because that's how the numbers work with the Fibonacci and the pivot points. They are relatively synchronized on the key reversal days and can line up exactly on the 38% retracement. We see our next leg up, and it moves beyond 127%, but not quite to 162, which is fine. But then on the next leg down, we see price come all the way back, and look at this distinct high right here, which becomes support. But on this swing up, from the leg here, the leg up here, price retraces 62%. It's a 10-day moving average. Its resistance becomes support. We see a hammer and a real nice reversal candlestick formation here. As the market winds up, we are at the height of the European session here, and the market winds up for a real strong bullish move. We reject at the day's high, consolidate before the next leg up on this swing to 127% and 162%. Have a look at our swings here now, but I just want to show you how this all is making sense in the long term. If we were to draw a trend line across these lows here, we would see that price here converges with the trend line and makes another attempt higher. Look at the distinct high right here at this exhaustion level of 162% extension. Price retraces generously. It retraces by almost 80 pips. It comes all the way back up. Look how it makes an attempt at the high, but there is selling pressure right at the high. there's a fade in buying pressure. This is actually selling pressure. This is not a fade in buying pressure. There's actually forceful selling pressure as we see this quick rejection, substantial rejection, and we see a nice price move downwards. Very nice tradable opportunity. You even could have traded the rejection of this high right here and made money. Yes. Please make note of this. And as well, we have a MACD divergence or a divergent state at these at this double top formation here. More than naming this a double top, I just call this it's the daily highs, and it's simply the interbank selling pressure at the previous day's high. That's it, folks. So we have a combination of factors. We have an exhaustion level, an extension, MACD divergence, selling pressure at the previous day's high. I like that this is retraced deep, because it requires a lot more volume to push it up and get through and hold above that level. So the deeper this retraces, if there's any attempt to exceed the previous day's high, there's a higher probability it will get rejected. To say that again, the further this has to go, the higher the probability that this will get rejected. So it's more difficult for price to hold above that high.